The rand has continued to claw back its losses against the major currencies after moving below 16 rand to the US dollar this morning. Meanwhile, resource stocks on the Johannesburg Stock Exchange are also making a recovery from last week's slump. The government has announced that it will cut 6 cents from the fuel price increases that were announced last night, as these were overstated, they say. But for more on this, as well as other business stories, we're joined now by Roy Mutooni. He is a market analyst at Absa Asset Management. Good to have you with us once again, Mr. Mutooni. Let's start with exactly what is moving the markets globally today and how the JSE is performing.
So it looks like markets got up on the right foot this morning. Very positive. I think the Alts is up about 1%. Even the top 40 is up about that percent. And like you said, the resources are rallying. The rand is stronger, and we saw that as well in the US as well. And I think basically it looks like we're recovering from that sell-off that came on last week on Friday on account of that Omicron virus when all the talk was then and we really didn't know what direction it was taking. It just looks like the market believes this is something that will pass, and that economic growth is still recovering nicely, and that what we're going to see is buoyant equity markets over the medium term.
So yesterday we received word from the Department of Energy that the petrol price was about to increase, but there has been a bit of an about turn. And talk to us about the impact of the Department of Energy's announcement that the petrol price will increase by 6 cents, as opposed to the 81 cents that they had originally stated.
Look, it's a relief. Any relief you get now from that petrol price is worthwhile. But just remember, the petrol price this year alone is up more than 40%. I'd struggle to find anyone whose salary has gone up by anywhere near that number. So the reality is the pinch on the pocket still exists. This may be a little bit of an early Christmas present, but it's still painful. It's still difficult. These prices are still high. They're still hurting consumption, still hurting consumers, and I think it's still going to feed into strikes and all the demands for higher wages to keep up with the cost of inflation and the cost of living going up. There's definitely a read-through on inflation, and we've been seeing that inflation ticking up little by little over the course of the year. So, yeah, interesting. Nice, but no, it's still incredibly expensive, and it still hits a proper dent in people's pockets.
All right, well, I think at this point, Roy, we will clutch at anything that looks like a saving. So the petrol price will increase by 75 cents as opposed to 81 cents as previously stated. Let's move on now to luxury brands firm Lux Holdings. They've announced a partnership with Edgar's. What does it entail, and how do you view what they're trying to achieve there?
So just by background, you remember luxury holdings came from the original taste brands who had a lot of food and jewelry there. And then because of debt and a whole variety of other things, they had to get rid of their Starbucks and all that. And they ended up just holding these luxury brands. So clearly their ability to distribute their products was constrained by the fact that they had to close all of these stores, and they didn't even have that much of a footprint at the time. So this partnership with Edgar's looks very interesting. They both seem to believe that they have similar target markets. Edgar still has a big footprint. Edgar still needs to attract people through its doors, and Lux Holdings needs to grow its distribution. It needs to get its product out there. One alternative is getting offices and getting retail stores, but that's expensive and it's a big commitment. If all you're doing is opening little department stores within Edgar's, that is lower cost. It allows you to do it in a slow fashion or as fast as you want without paying all that. So I think it's an interesting way for them to grow their business, and I think it's beneficial for both of them. Remember, both of them are struggling. The two of them coming together, selling a more diverse basket to their common customers must be a good thing. I think it's a great idea.
Does certainly sound like a win-win there. Now, Bidco says it has gained some market share and its trading results have been positive in the first quarter. Tell us more about that.
So this was a trading update for the first quarter, which is basically July to October. for Bidcorp. And it was pleasantly surprising, because I think one of the reasons Bidcorp has sold off was because a lot of people associate Bidcorp with lockdowns and everything, because they provide food distribution services. But what they're saying is that they've got such a distributed, such a wide footprint globally, that when there are lockdowns in one side, the other side doesn't have, and when one opens up, the other one closes down. On balance, they're seeing good growth in revenue, good widening of margins. They've also seen higher costs, which is the inflation we keep talking about. But by and large, they've been able to work around these from the way they have their suppliers and also what they're doing with their customers. And even where they've been hit, where travel and leisure is not recovering, they're seeing the independent restaurants are recovering well enough to offset it. So a really good update. I think it surprises the market, and it just shows that this is a business that's going places. It's really big, gained market share, and they're able to navigate their way through the difficulties which I think the market thought they would struggle with. So good update, I would say.
Roy Mutooni, analyst at Absa Asset Management, thank you once again for today's market update.